Welcome to the Invest Like a Boss podcast.
I'm Sam Marks.
And I'm Johnny FD. We're self-made entrepreneurs who invest our own money and use modern technology to invest like a boss.
Join us each week for exclusive interviews with our network of modern investors, business owners, and multimillionaires to discover new ways to invest our hard-earned cash.
Hey everyone, this is Johnny, and welcome to episode 24 of the Invest Like a Boss podcast. I'm back with my co-host, Sam Marks, and we have on Sam, the financial samurai, this week.
Yeah, awesome guest, and very happy. You know, it's somebody that I've been following for a bit, and a lot of our listeners in the Boss Lounge have been chatting about Financial Samurai and a lot of his content. So we reached out to him, and very good to have him agree to come on the show.
Yeah, I think it's going to be really cool to kind of hear his backstory, because he writes a ton of great articles on financialsamurai.com about wealth, and he basically retired pretty young, right? Like 30, was it 34?
Yeah, he's still a little bit active. You know, I don't think anyone can truly retire in their early 30s. It's there's a lot of there's a big dark side to that, but yeah, at least in a financial sense, yeah, he was retired by 34, from my understanding.
Yeah, and I know he wrote a book about basically engineering your layoff. You guys can check that out, but I'm sure he'll talk a little bit about it. But I think it's cool. I mean, I honestly, personally, wouldn't want to retire in my 30s anyways. I think there's too much enjoyment out of life to just stop working. But the fact that he stopped working his corporate job and moved on to things he actually enjoys doing, like his blog and investing, I think that is the dream of most people.
Yeah, I agree with definitely ditto that. And it's kind of a situation that I've been playing around with as well after we sold the business and trying to do nothing for a while. And there's too much of a void. You know, you have to get back into doing something that you're passionate about, whether it's just playing tennis or it's building a business or helping people. And I think Sam from Financial Samurai is one of the best people out there to talk about it. And I also think this is an awesome episode to follow yours up, because your episode's been a smashing hit. And I really think we should do more of these, you know, how people got from kind of 0 to 1 stories, because of course, investing's awesome. We love investing, and all of these stories end up going into investing. But a lot of people are interested in how did you get your start to put you in a position of being able to invest full time.
Yeah, definitely makes sense. If you guys aren't part of the Boss Lounge yet, stay tuned to the end of the episode, and we'll talk about how you can join and how you can recommend guests and different topics that we're going to come up with. So before we get started, where in the world are you, Sam?
I'm in London. I'm in London. I'm on a short stopover back to the US. It's been, every time we talk, you know, we're someplace different, but this has been the end of about a 2.5-month road trip through Europe. Part of that was with you early on in the eastern countries, the far eastern countries, should we say? And it's just ending now. So now I'm flying back to the States for a bit. I'm gonna hang out in the Southeast, chill with my dog, my actual dog, my parents, and maybe do a little sailing in the Caribbean.
I like that. It sounds fun.
How about you?
I'm in Chiang Mai right now for another week exactly, and then I'm going to be in Los Angeles for a while, visiting some friends and family, and then heading over to Hawaii. So
dude, that's an awesome trip.
Yeah. Next time I talk to you, I might be on the islands again. So I'm excited.
Well, we're definitely gonna have to record while you're on the islands. And dude, while you're there, do me a favor, like look around Hawaii quite a bit, because I just keep hearing amazing things about Hawaii. I think it's gonna be too expensive, but take a look and get a full feel for it.
Okay, we'll do. So without further ado, let's welcome onto the show Sam Dogen from Financial Samurai.
Everybody, welcome back. This is your co-host, Sam Marks, and I'm joined today with someone that I've personally been looking forward to having on the show for a long time. It's Sam from Financial Samurai and the author of How to Engineer Your Layoff, which is a book about helping people to negotiate their severance packages to escape the rat race. Sam, thanks for coming and joining us, man.
Hey, thanks a lot for having me.
Yeah, so I guess I can't say coming over here and joining us, because you're actually in San Francisco.
Yeah, good old San Francisco. Probably, I think, the most undervalued city, I think, in the world in terms of real estate. And everybody is always shocked to hear that. But I've been everywhere. And San Francisco, with all that's going on, I think, is the place to be.
That's interesting, because everything I've ever heard about it was it's a real estate bubble that's driven by the Silicon Valley bubble and tech bubble. And, every time I've been out there looking at real estate prices, it's just like, oh my gosh, like who can afford to live out here? But it's an interesting perspective that you have about the real estate prices.
Well, it's interesting because I was thinking about moving to Hawaii, where my father's side of the family is from, back in 2014.
Mm-hmm.
And I was looking at these, my ideal place would be like a home with a ocean view and, like nice lanai where you can sit out and type and drink a Mai Tai or whatever. And I was looking at these homes, and they all cost like $1.5+ million, and you had to fix it up and spend a couple $100,000 more.
Mm-hmm.
And I was just thinking to myself, wow, that is almost like San Francisco. But the big difference is that unless you're a doctor or a lawyer or a dentist or something, it's really hard to make any money in Hawaii,
mm-hmm.
like more than maybe $30,000 to $50,000 a year. But in San Francisco, if you just go on like angellist.co or just ask your friends or go to a coffee shop, it's literally as if everybody is making six figures, whether as a full-time employee or as a consultant. So I just decided, I'm going to go buy my own view home in San Francisco in 2014 and just stay for another 10 to 20 years or whatever, because there's so much opportunity here.
Wow. So who's living in Hawaii? It just must be people with, come into a lot of money one way or another, but obviously people aren't earning a living there.
Well, that's the thing. It's you either are a professional, doctor or whatever, or you import your money. You've made your money elsewhere,
mm-hmm.
and then you go to Hawaii. So if you think about like Larry Ellison, he bought the island of, I think, Lanai.
Mm-hmm.
Mark Zuckerberg bought, 50 or maybe it's 500 acres on the Big Island. There's just a lot of money that goes to Hawaii to retire and just to have their second homes, which makes it, unfortunately, unaffordable for the local people.
Mm-hmm.
And that's what you're kind of seeing in places like Vancouver, for example. I mean, I can't think of one big company in Vancouver that would be driving their real estate market at a 1.3 to 4 million median home price.
Mm-hmm.
But I can name tons and tons of companies in San Francisco, Bay Area, like Google, Facebook, Apple, whatever, that would justify these prices a little bit better than in Vancouver, for example.
Yeah, so Johnny's out in Hawaii right now for a dropshipping conference. It's either this week or next week, and I haven't been out there, but I'm intrigued to go because everybody keeps talking about it as like if they could live anywhere in the world and it didn't matter about money for the rest of their life. Yeah. There's a lot of people that would put Hawaii down as number one.
Yeah, I mean, Hawaii is awesome. Digital nomad lifestyle, I like it. I think it's great. And if you can live in Hawaii, it's got everything I think that perhaps Thailand does.
Mm-hmm.
The weather, the beaches, the lifestyle, but it's also got like, you're still part of America,
mm-hmm.
Americana, the sports, the football, basketball, whatever, the political debates, I don't know. And it's a good lifestyle. It's really similar, but I think obviously the Thai food is much better in Thailand. So.
Oh yeah, can't beat that for sure. Been missing that for about 6 months now, so looking forward to getting back at some point soon. And I guess with Hawaii also, you have a lot quicker access to Asia, and you also have quicker access to mainland U.S. or Vancouver or wherever. So it's a pretty sweet location. Yeah,
pretty good. You can start your day early, end early, and it's pretty central, and you have a lot of direct flights, right?
Mm-hmm.
So I think if I were to choose, I would say Hawaii is the number one place for digital nomad.
Dang, that's a big statement. I like it. So if you could have, getting a little off track here, but I'm really interested in your opinion on this. If you could have one house as your primary residence and 2 vacation houses that you weren't going to rent them, so you couldn't monetize them, they would just be straight up, I'm going to vacation at each one of these for maybe a month a year. Where would you have the 3?
So I'd be central in San Francisco because I think it's the best balance of lifestyle and opportunity. Then I'd have one house in one of the islands in Hawaii, and then I'd have like a pied-à-terre in Manhattan because I think Manhattan for 6 months of the year is the best place on earth.
Dang, you city boy.
So much buzz. Yeah, I mean, Hawaii can be like on the ocean front on the North Shore where it's really chill.
Mm-hmm.
But San Francisco and Manhattan, I love it. It's just, there's so much action going on that you'll just never get bored. One of the biggest fears in early retirement is just, kind of getting bored because all your friends are working and nobody can go and play with you. But there's tons of people to play with and hang out with in New York and San Francisco.
Yeah, I just spent about a month in Budapest, and the grass is just always greener. After the month in Budapest, I was like, man, I just want to get outside the city. And we went and did a kind of a month-long road trip through the Alps in Austria, just staying in small villages all along the way. And I was so ready to get back to the city. I felt like I was just spun off and exiled from humanity and was like outcast to these cities. And you really, you really forget about the need to be able to connect with people, and especially have intelligent conversations after, a month of just being on the road and sipping coffee on the countryside. It seems great when you're in the city, but if you do it for too long, I feel like the human need to just get back and connect is really, really strong.
Yeah, absolutely. Absolutely.
So we had, so during the road trip, actually, I had my girlfriend reading a bunch of your blogs out to me as entertainment on the road and learning, instead of having a typical audiobook on. And with English being her second language, she wanted to also thank you very much for learning some new business vocabulary. And
okay, cool.
Yeah, it was great. And I think what's really inspiring about your story, and the reason I love it so much, the reason that a lot of our listeners who are familiar with your blog and your story love it so much, is that it's realistic, and it's not a get rich quick scheme. It's much more about living responsibly, making smart decisions, and yes, of course, accumulating wealth for an early retirement, but taking practical steps on the way to get there. So there's tons of value bombs you could hit us with. I would really like to kind of focus a little bit on your actual story and kind of the beginnings of like how you got started, and of course building up to how you were able to retire by the age 34.
Yeah. So I think the biggest irony is that life is too good in the States. I grew up in Asia, Zambia, Philippines, Malaysia, Taiwan, and life was not as good. And I kind of recognized that as a kid, because I'd have to come back to the States for vacation and visit relatives. And there's like this clear compare and contrast of not so good life and really good life in the United States. Mm-hmm. And so I had this perspective that I always carried with me until adulthood. And when I first started working, it was a really tough job. It was at Goldman Sachs in New York City, and I didn't know how I was able to get that job. I basically got on a bus one day at 6 a.m. from my school to go to a career fair. And because I was the only one to get on that damn bus at 6 a.m., the driver said, "Hey, let's return this bus, and I'll take you up in a town car myself." And I said, "Okay, that sounds good." And I was at this career fair, and I got this job after 50 interviews at the world headquarters. And what happened was I really didn't like the job. I was excited I had a job. I was excited I worked at the firm, but I had to get in at 5:30 a.m. every morning. And many times I would work until like 8 or 9 p.m. And that's like brutal 13, 14-hour days every single day. And then the weekends I'd have to come in because I didn't know crap, right? Mm-hmm. And I was just a cost center. I was a cost center to the firm, and I had to prove myself that I was worthy of being an employee. And so because it was a tough environment with tough working hours, I told myself literally in the first, I think, 1 month, I was like, there's no way I'm going to survive this business beyond, 30 years old. I mean, if I could survive 5 years, I'd be lucky. So I told myself right then and there before December 1999, I need to save as much as possible and live as frugally as possible because I won't be able to survive.
You survive in a physical sense, or just stick around for the job?
Well, stick around and also a physical sense. I mean, I remember, I was like a trim, I'm 5'10", I was like 155, I was trim, I played a lot of tennis, and I remember after 6 months, I was like 170, and I was like, a little pudgy, and then I was getting this like plantar fasciitis in my foot, and then I had allergies, and like my whole health was going downhill, and I was just like, no, there's no way I can make it for the long term. And so that was when I was just like, okay, lock down, save, live in a studio with my buddy. I don't give a crap whoever comes over. I'm working anyway, so who cares? And I'm poor, so let's do this so that one day I might be free. And the only saving grace for me was in 2001, my VP got a call from a headhunter, and they asked her whether she wanted to move to a different firm in San Francisco, and she said no, because her mother was in Manhattan. And she says, well, why don't you talk to my colleague here who actually goes out to San Francisco once a month to cover clients. And I picked up the phone, and I was like, oh, sounds good. San Francisco, it's closer to Hawaii, more balanced lifestyle. I actually don't know anybody in San Francisco. Why not give it a go? And so I moved out to San Francisco in 2001 with a raise and a promotion, but I kept my lifestyle like a college student. I lived at this dump at the edge of Chinatown with this crazy person for like the first 6 months, and then another person. And, we'd always be getting woken up by 4 a.m., 5 a.m. garbage guys and whoever else, because we were like living in this massive complex that it seemed like it was for lower income folks, which is fine. And just kind of kept that discipline until one day I said, I think I need to move on. And that one day was really in 2009 when the financial crisis happened.
Yeah. And so what age were you when you were living the frugal lifestyle outside of Chinatown?
Oh, so 22 to 26. So, it's basically the frugal lifestyle started, right out of college until while I was in Chinatown. And then basically I was like, there was a point where I didn't want to like rent such a crappy place anymore. And I was paying about $1,800 a month in rent, split with another person. And I told myself, if I'm gonna, I don't want to pay more than $2,000 in rent. So instead, I finally bought a place in 2003 when I had just turned 26.
And was the real estate market still like suppressed from 2001 when you bought the
house?
No,
the irony is that so the dot-com bubble burst in 2000. And so the money from stocks and internet companies actually flowed into real assets, i.e. Real estate. And interest rates started going down. So actually back then, the real estate market was still quite strong. And it was never, San Francisco was never cheap. But I remember just kind of parlaying a good investment I made in a .com company.
Wait. That doesn't sound right. You just talked about the .com bust and you ended up making a good investment in it. Was it a private investment or?
No, it was just I bought this funny company called DCSY, and it was like a Chinese internet company that I had. It was kind of like a China Yahoo, and all it had on its homepage was like a dial pad. But it was a penny stock. It was like $3 a share, and I was like, oh, this sounds interesting. Let me buy some, right? So I bought $3,000 worth, and then what you do is you say, oh, hey buddy, I bought this. What do you think? And they'll be like, oh, okay, that sounds pretty good. And then pretty soon, everybody at my desk and on the street were like, what is this stock? This Chinese internet stock back in 2000, and it went from like $3 a share to $150 a share.
Dang, that's some serious return.
It went to like $180 a share. So $3,000 went to about $180,000.
All right, so it is a get rich quick scheme.
It's a whole topic if you want to get into it. But active versus passive, you can't really get rich if all your investments are passive. So a portion of your money you can go try to bargain hunt and find some unicorns.
Yeah. So you were able to start saving money while you're out in California just through the frugality and also, you're spending $2,000 a month on rent. Like I've been out of the US for like 6 years now. And that to me is just unheard of, right? Because you can, even in Thailand or, down in Central America or a lot of places like the digital nomads hang out, you can rent the nicest place in the city for, $1,200 a month. And most people are living on, out of an apartment that's $500 a month and is really, really nice by US standards.
Yeah. Yeah, I mean, it's expensive, but I was paying $1,800, but I was dividing it by 2, so it was only $900.
Yeah.
Right. But, the income was pretty good. But yeah, so got lucky, but I was still really frugal, and I knew that funny money wouldn't last. So I've always had a mindset working in equities is to convert any good fortune, any funny money you make in the stock market that's totally just numbers and paper wealth into real assets. So that's what I did in 2003 when I had just turned 26. I remember I turned 26 June 15 and I closed like the very next day. And it was interesting because by that time I was kind of getting totally disillusioned by working, making money. It was probably like a quarter-life crisis. I'd come out to San Francisco, avoided like getting my head chopped off because of the many rounds of layoffs that ensued after I left, and then after 9/11, right?
Oh, yeah.
And then I was like, oh, man, life sucks in the sense that what's the point of life? People are dying, 9/11, money is just a means to an end, and the idea of trying to make more money just didn't seem really appealing anymore. But being able to buy that property in 2003 gave me a huge catalyst to get back into the saddle because there was a huge mortgage that came with that property.
Sure. So you took your took your earnings from that stock sale, which was, let's just say ballpark $150,000, and used that as a down payment for a property in San Francisco.
Right. So then, the property was like $580,000. I put like 25% down, and then suddenly I was like, oh, I got this big mortgage. I better not get fired. I better start working hard again.
Right. So then it's at that point you're still with that job.
I'm still with that job, and I ended up with the new job for 11 years until 2012. So yeah, from 2001 to 2012. But, so I was disillusioned as a 26-year-old, and then I became disillusioned again as a 32-year-old, a 32-year-old, because the financial crisis happened. I thought I was doing everything right. I was aggressively saving. I wasn't buying crazy things. I was investing. I had a great proper asset allocation model, and then I still lost 35% of my net worth that took 9-10 years to build in a matter of 6 months to 12 months.
And when you say you lost your net wealth, that was net worth. Was that also included in the decrease in your property value that you then owned but had a mortgage on?
Yeah, property values, stocks, even bonds. And it was kind of like a come to Jesus moment. You're like, wow, I thought I did everything right, but I still got crushed.
Right.
And if I'm getting crushed, other people are getting crushed, and I could get fired, because there was already 6-7 rounds of layoffs by then at my firm, and probably every firm in finance. And I thought, hey, why not start a site to get some therapy? Some people smoke, some people drink, some people do much worse. I was like, well, I like to write. Maybe I can get some therapy by writing out my thoughts and feelings about making sense of all this chaos, and maybe other people would be able to relate. And so I started Financial Samurai in 2009, and a lot of people related with a lot of the things I was saying, and a lot of people had fear, and a lot of people were just didn't know what to do. And I think together we kind of grew out of that recession and grew out of that fear to empower ourselves and own our financial independence.
Yeah, and it's hard to remember, but in 2008, people didn't know where the bottom was. People were thinking this is Armageddon, and a lot of people today still think that it was close to being really, it was really bad, but they said it could have gotten so much worse, right? And a lot of people we've had on this podcast, that was the turning point in their life, or at least in the way that they thought about money and wealth and investing. So when you started the blog, you said it was just for therapy. Did it just start off as a blog a week, or is it more than that?
I could write all day, every day. So, but I also had a day job. So basically I was at maybe 3 to 4 times a week. And there were just 500 to 800 word entries and my thoughts on money, on life and relationships and happiness, really. And what I discovered after writing pretty methodically 3 to 4 times a week for 2 years was that it actually had some potential. I remember my dad telling me in 2006, he was like, hey, you should start a site because you could actually make some money and you enjoy writing. Because he was telling me about Google AdSense and all that. And I said, I don't know how to start it. Yeah.
It's usually the kids that tell their parents about that, but you had your dad telling you about it. That's pretty cool.
Yeah, I had my dad telling me about this, and he's totally not tech savvy or nothing. And I was like, that sounds great, but I'm too busy. I just finished business school part-time at Cal, and I was working full-time and going to business school part-time, so I was already getting my ass kicked already. And I was like, I don't want to create something else to do. I just wanted to focus and leverage my education to do the best I could do at work. And so if I started then, I think I would have been much better, or bigger and better maybe, but better late than never, as they say. And I remember in October of 2011, this was about 2 years after I started Financial Samurai, and while I was still working, I was sitting at the top of the crater in Santorini, Greece.
Yeah, dude, that's one of my favorite spots in the world.
Oh, so amazing, right? And it was my first time. I rode the donkey up, all that fun stuff, and it was we were walking around for 3 hours. And I was like, I'm going to just get a Mykonos beer, this €7 Mykonos beer at the top of the crater and overlook the crater. And I was pumped because there was Wi-Fi back then, and I had my iPhone. And then in my inbox was this guy from London who I'd been advertising with, or who's been working with me on advertising on Financial Samurai. And he's like, hey, I would like to advertise this banner. Do you mind if I do so for $1,200? And at the time, I was like, oh, yeah, that's a lot of money. And I was like, sure, why not? Send me the code, and I'll put it up via my iPhone, and here's my PayPal. So I did all that in about 30 minutes, and he sent over the $1,200 instantly. And I was like, yeah, this is amazing. And I was telling the waiter, I was like, oh, give me another Mykonos beer, buddy, And it was then that I realized, oh man, maybe I could actually do something else after finance and actually, have a livable income stream if I actually left.
Yeah.
That was when I started steaming.
Was there anything to justify that, like that initial ad placement, or was it just like, hey, I have this ad, I'll give you $1,200 to place it, or was he like tying that into some type of, traffic metrics or anything?
Well, so back then in 2011, there was Google PageRank and like page authority and all that. And now nobody cares or nobody knows what their PageRank is. Literally, I have no idea what mine is. But back then it was really important. So I remember Financial Samurai had a PageRank of 5, which is pretty good.
Yeah.
And so like, I want to place this ad with a link back to my site, and I'm going to get authority, right? Yeah. And back then, I'm like, okay, sounds good. Who cares? It's my site. I'll do whatever I want. And, lo and behold, Google ended up coming down on site with such type of advertising. They never came down on my site because I probably just didn't do it that often. But I had a PageRank of 5, and so many advertisers wanted to advertise because of that PageRank.
Nice.
And so it was easy money, and I was like, wow, there is light at the end of the tunnel. There's a new chapter out there.
Yeah. So that was your aha moment. What a better place to have an aha moment is in Santorini. If anyone hasn't been to Santorini, you want to be inspired, go there this next coming summer. I probably wouldn't go in the winter, but August, you will not be disappointed. So what happened? What happened after that? Like in terms of quitting your job, how did that go? And what was the emotional feeling of doing that?
So in 2011, I was a executive director at a large financial firm, and executive director is actually one up from a vice president. So that's totally opposite in tech. So in other words, my income was very good, and my biggest fear was, what kind of idiot at age 33, 34 would leave a multiple six-figure income day job to go make, less than $50,000 a year on his website, right? Like that's like being, petulant, like not being patient enough to see the plants bloom after you plant that seed, right? Because I was 13 years into the, 11, 12, 13 years into the business. And, most people work for like 20 to 40 years. But I just felt that because of the downturn, people who worked in finance became public enemy number one.
Right.
Like, regardless if I was working in the international equities business and I had nothing to do with you not paying your mortgage or whatever bank giving you some crazy terms on your interest rate that suddenly started going up after your term was over. I had nothing to do with that. But Main Street, painted Wall Street as, all evil. So that didn't feel really good. Because, I asked my friends and I asked my parents, am I an evil person? And they say, I think you're okay. So I was kind of confused. And then 2, the pay started to decline structurally. So it didn't matter whether you were like a top 3 revenue generator. You had to subsidize other departments that were loss-making or in trouble. And I understood that because the whole financial services industry and many other industries were in trouble. You had to be there as a team together. But it just didn't feel good, right? You just, I think most of us in the digital nomad community or entrepreneurs, all we ever want is to have a correlation with effort and performance and reward. And that wasn't happening anymore. It was like I was going to work in a large organization with only 2% or 3% pay raises or no raises, no matter how well you did, right? So those are the 2 things that was making me think, And then, of course, once I had the aha moment in Santorini, I was like, oh, okay, well, there's this other thing. And I knew that living in San Francisco, especially, if I didn't make the move to do something entrepreneurial, I would forever regret it when I was like 70 years old looking back. And the more you make and the more entrenched you are at your job, the harder it is to break free. So I decided then in Santorini I had to move on. But I wanted to do it in a financially wise way. And that financially wise way was being able to negotiate a severance after 11 years of employment with one firm. Because if I had quit, I wouldn't get a severance. I wouldn't get 3 years of deferred cash and stock compensation, and I wouldn't get this 7-year vesting period for this partner investment we made during the financial crisis, where a portion of our bonus was used to buy these toxic assets, as the media like to call them, basically mortgage-backed securities and all that around the world. I would lose all of that, and that would be multiple hundreds of thousands of dollars of income lost. So I told myself, if I was able to negotiate a severance to get laid off and get all of that deferred compensation, I would take the move. I would make the move. And that's exactly what I did in March 2012.
So for all the listeners, Sam literally wrote the book on this. So I don't know if we can touch on the entire story of that, because it's an entire story of itself. So I would just say, read the book if you're interested in more of this story. But Sam, maybe give us just like the 20-second breakdown of it.
Yeah, so I want everybody to know, everybody who has a day job to know that you are more powerful as an employee than you think. Don't think about your boss and HR and legal as, Goliath, right? Think about them as equals, where they just want what's best for themselves and for the company. And to make, to have a negotiation about a severance, you have to provide value. In my case, I had been there for 11 years. I knew all the clients, and I was able to hire someone to replace me. I basically hired someone to replace me and to introduce him to all my clients so that the revenue wouldn't drop as much as if I had just said, see you guys later. So there's always a benefit to being able to negotiate a severance. You just have to find out what that benefit is from your employer's point of view, and always know that if you quit, you get nothing. But if you get laid off, you get so much more. So never quit, get laid is my tagline.
I like it. So read the book if you want the full story. I certainly will be after this. And so big move, man. You quit your job, you go full time on the blog. What's the early days of that like? What's the feeling?
The feeling was like, oh my God, what did I do? Did I make the right move financially? Am I going to be an idiot? Are people going to think I'm just a failure? Because again, my biggest fear was I would try hard and nothing would happen. Mm-hmm. But I tried hard, and the correlation with effort was really, really solid. So I was able to write more. I was able to write more in-depth articles. I was able to communicate my thoughts better and connect with thought leaders more frequently. Mm-hmm. And what happens is, when you burn your boat, there's only one way to go, right? You're either going to drown and die, or you're going to swim to the other island and survive. Right. And so I burned my boat, but really I had a really nice luxury life jacket on the side because I had the severance that provided me for about 5-6 years of living expenses.
Nice.
So I told myself, I'm going to try to replicate my day job income before my severance runs out. And so that's what I've been trying to do.
Dang, that's awesome. Yeah, that's awesome. 6 years of severance. I mean, that gives you a nice little cushion. So did you at that point start doing more active investing? So you obviously were starting to make money off Financial Samurai and your material. Did you start investing into other things, whether active or passive?
So what happened with my financial situation then was I had built a passive income stream worth about $80,000 gross a year by 2012. So I knew that if Financial Samurai failed, I'd at least have $80,000 a year to live off, which is enough to live a decent lifestyle for one person in San Francisco.
Right.
Because my mortgage was locked down and everything.
Gotcha. What was that income stream, if you don't mind sharing?
Yeah. So the income stream was from my rental property that I bought in 2003. Okay. That I talked about that gave me that catalyst. Back then it was renting out for like $3,600 a month. Mm-hmm. Now it's renting for about $4,200 a month. It is renting for $4,200 a month. Mm-hmm. Other income streams include dividend income as well as CD interest income. I had put a lot of my money, I've always been putting about 30% of all disposable income into risk-free assets, just because it's so volatile in the stock market, finance. I mean, since 1999, there's like these massive corrections that just crush people, right? So I thought it was prudent to continuously invest about 30% of my disposable income in CDs. Mm-hmm. So I had a lot of CDs that were paying about 4% interest a year guaranteed. Mm-hmm. And then, of course, dividend income and just some side hustles. Yeah. So 80,000 was like, okay, worst case 80,000, and then Financial Samurai, I would think like worst case it could make like 30-40 grand, like worst case, because it had been doing well already. So then I was like, okay, worst case 100 to 120 grand, not bad. Let's give it a go.
Yeah, I mean, look, with 120 grand, you can always move to 99.9% of desirable places in the world and still be doing just fine. And if you want to move to northern Thailand, you can be a king, or anywhere in Southeast Asia. So yeah, sitting really pretty.
Yeah, and the 80 grand took, let's see, I started in 2000, so yeah, it took 12 years to generate.
Mm-hmm.
But as you recall, like from month one of getting my ass kicked at work,
Mm-hmm.
I was determined like hell to save and invest everything I made, or as much as I could make. So it was like 50 to 80% of my after-tax income. Every single, all of that money was going to investing and saving. Because I was determined, and I just knew myself that I couldn't last. I would be like, by the time I was 40, I'd probably be, go from 155 pounds to maybe 225 and just be like terribly miserable and unhappy.
as the way of the American corporate worker.
Yeah, I mean, I just could see it. And I just saw it through my colleagues, and my senior colleagues were wealthy, and I didn't see a lot more happiness. I actually just saw a lot more stress, and wealthy people divorcing, and the same crap like everybody else.
Yeah, that brings up a good question. Do you think there's an ideal income, annual income that is suitable or not suitable? Let's see, that's just ideal for happiness, because obviously, once you make so much money, making more doesn't really bring any more happiness. It probably just brings you headaches. And there's lots of different theories out there on how much the ideal is to be happy and content. Do you have a figure in your mind?
So the research says 75,000 a year. So 75,000 is across America. I think that's probably appropriate for the average. And I would say like for expensive cities like Paris, London, San Francisco, Manhattan, Vancouver, I actually think that number is more like 200,000 per person. And I do have a post that talks about a $200,000 budget for a family of four and how quickly that goes.
Right.
Because of our progressive tax system, because of high housing costs, because of the cost of raising children, education, and so forth. But then, of course, when you go to Thailand and Southeast Asia, I think you can live great. I used to live in Malaysia. I think you can live awesome on $3,000 a month.
Yeah,
for sure. So it's whatever you make it to be, and I think what I realized from making good money in 2012 to making like 80% less in 2013 when I left my day job is that once you have all your basics covered, you don't really need much money at all. I was just as happy. I was actually more happy. I was afraid in the beginning for probably the first 2 months whether I made the right move or not, but I was so happy when I was making 80% less. I would wake up, same old house, right? Drink my same old water, my same old food, because it's not that expensive to survive. And then I'd just go play tennis in the free public park with other, tennis bums who were just hanging out and having a good time. And, the money, I think the desire for money is more driven by what you see other people making and what other people are showing, on social media and all that. And frankly, it's kind of annoying.
Yeah.
And so I've taken kind of a different approach where it's called stealth wealth, where, you want to be rich, but you want to be stealth. And you want to be rich just for yourself and your family and your friends and the things that you care about, not so you can show off.
Right. And you were also, when you had that drop in pay, you were also trading, you were trading income in a sense for lifestyle as well. So there was that newfound lifestyle improvement that you were able to, you could wake up and put a robe on instead of waking up and putting on a suit and stressing through road rage on your way to work.
Yeah, it's there's a great saying, hell is other people. And if you think about all the difficulties in your life, the stresses, it's because of other people, whether they stabbed you in the back or broke a promise or betrayed you because they found someone better, And then, of course, all the good things in your life is also due to other people. But to be able to decide my own time, to do what I want to do, all anybody ever wants is the freedom to make their own choices. They can be bad or good, but because they were your own choices, whatever happens, I think people are satisfied with that.
Good advice. I like it. So as you started growing the site, I imagine over the course of a few years, the income from the site started to tick up, the income from your other income streams started to tick up. Did you start reinvesting into additional, start playing with new investments, or did you kind of keep your same asset allocation model?
Oh, I definitely invested in different investments. Well, once you reach financial independence, whatever that definition is to you, or whatever that financial nut is to you, your number one goal is to protect your principal at all costs. And your number two goal is to not forget your number one goal, because if you lose 50% on your financial independence nut, you need to get back to even. It'll take 100% to get back to even. And that's a disaster.
Yeah.
And like the larger your numbers, the more painful it will be, even though the percentages might be the same. You know, we don't really, I mean, we feel more pain when we lose than when we make, right? That's just kind of the way it is. And so I continue to be very conservative, and instead of trying to shoot for high single-digit returns or double-digit returns, I started to shoot for singles. In other words, maybe 2 times or 3 times the risk-free rate of return, which is simply the 10-year bond yield, which simply is the money that's guaranteed you'll make if you hold on to it, because the government is sovereign and won't go bankrupt, right?
Which kind of will lose against inflation, right?
Yeah, I mean, so inflation times 2 to 3 times. Inflation times 2 or 3. So as long as you can kind of beat inflation, which is like 1.5% to 2%, you're doing all right. So my goal was to make sure my investments were a tailwind and not a headwind. And what I found is that I actually do not like having too much of my money in the public stock market and bond market, because you are a minority investor, passive investor with no say on what's going on, right? So when Yahoo fires their CEO because he lied on his resume and he gets like a $50 million severance package, you know, that's kind of crazy. And I don't want to invest in that. And there's like all these shenanigans that seem to happen in public companies all the time. What I actually wanted to do was asset allocate into private companies or more things I had more control over, because I believe that nobody cares about your money more than you.
Yeah.
And so I looked at how like college endowments invest and other very wealthy people invest. And they invest really for the long term, where they lock their money up in private investments, private equity, venture debt, real estate, and so forth. And it does look like, you know, I'll tell you in 10 years, but so far so good, that there's a better return if you can lock up your money for the long term. So all these private equity funds and all that stuff, they have like a 7 to 10 year lockup. And if you can lock it up for longer, your IRR, your internal rate of return, I think does better over the long term.
Right. Yeah, I read on your blog that endowment funds and high net worth people usually have between 10 and 30% of their gross wealth in real estate.
Alternative.
Real estate. And where do you lie with that stuff in your overall portfolio with real estate?
So I would say, you know, depending on how you value my media company, I would say my real estate as a percentage of my portfolio is about 30 to 40% of my net worth. And it's kind of skewed because I bought a fixer in 2014 in San Francisco when I decided I didn't want to buy in Hawaii because of the income risk. So it's about 30 to 40%. Alternatives is somewhere around 10 to 20%. You know, the biggest joy I have is actually locking my money away and having it compound in a way that I don't even have to think about it over a 5 to 10 year period. And the biggest money annoyance I have is buying something and watching the daily ticker and seeing bad things happen because of things I don't agree with.
Yeah.
And that's just so annoying. So I try not to look.
Going away for the emotion, or taking a ride on the emotional roller coaster of the stock market. Yeah.
So then public equities is, you know, like it's only about, I would say 20 to 25% of my net worth.
Right.
And then about
go ahead.
5-10% is risk-free.
What's an example of something that you're just mentioning you lock away money for 5 to 10 years compounding? What's an example of something like that you've invested in?
Yeah, sure. One, I invested in a venture debt fund, which has a 5 to 7 year expiration.
And what exactly does venture debt mean?
So venture debt is, let's say, so you basically lend money to companies, usually private companies, that have already raised equity rounds from really great VCs. So your idea is to go in and out. You know, you lend money at as high a rate of a possible, you know, maybe it's like 12 to 16%, maybe it's 12 to 20%, I don't know. And the duration is for 1 to 3 years. And basically you do due diligence on the company's revenue and balance sheet and all that. So you have with great confidence that they can return that money back to you. And then you just get out. So you're not waiting for like the massive equity payout where it becomes a 100 bagger, you know?
Yeah.
You're just trying to get in there and make sure the company is able to survive long enough, you know, over a 1 to 3 year period, so you can get your money back.
So it's not exactly like a convertible. It's not like a convertible loan or convertible debt, or even like a bridge loan. It's just straight up debt to the company with.
Yeah, it can be like a bridge loan for 1 to 3 years, but I guess bridge loans are generally like 1 to 2 months, or much shorter. But yeah, so that's something that's going to have a 7-year life. I invested in a real estate crowdsourcing investment in, of all places, Conshohocken, Pennsylvania, recently.
Right.
And because I think Conchi, Pennsylvania, based on my due diligence and asking, publishing a post and asking people from around there what are their thoughts. I don't know, based on my research, that's a growing place, and it's a commercial real estate property that's going to be redeveloped, and they're going to try to get more tenants. So that's a 5-year investment. So yeah, I really like locking that stuff away, money away, because it forces you to try to make better investments, and it forces you to hustle to not take the money you have for granted. So if you lock all that money away, you're more motivated to work hard and try to find other ways to make money.
Yeah, I like that. Have you taken a look at any of the new crowdfunding for real estate platforms? I think we had Fundrise on the show recently, and then there's Realty Share or Realty Shares. Yeah,
right. So that was the investment through Realty Shares, was the Conshohocken commercial property.
Cool.
Yeah, it's real estate crowdsourcing.
Yeah, I'm a big fan of those things. They're the Fundrise. Johnny and I both invested money in. It's basically like a REIT. I know Realty Shares is slightly different because you're actually selecting a property, right? Yeah.
But yeah, REITs. Any investment that produces yield in this low interest rate environment has been bid up and has attracted a lot of dollars. If you look at REITs, you look at bonds, you look at rental properties, physical rental properties, they've all commanded premiums because, the risk-free rate of return right now is 1.7%. Nobody's getting any yield, so everybody's looking for yield. And I think that's gonna continue to happen, that trend. I think for the rest of our working lifetimes, I think interest rates are going to stay low for at least another decade, if not more. Because, for one, if you look at where the 10-year bond yield was in 1985, it was 16, 17%. We've gone straight down for 35 years in a row. I think that's partly due to understanding economic cycles better, and also technology and communication.
Yeah, and guys, Sam blogs about a lot of this stuff. He includes a lot of charts and informative information in a lot of the articles he writes, so please check that stuff out. Some great content in there. And Sam, I got to ask you, since you've been investing for so long, and especially even in public markets, and have a background in finance, what are your thoughts on new robo advisories like Wealthfront and Betterment?
I think they're a no-brainer. I think they're a no-brainer because the fee is so low. For 25 basis points, or 0.25%, you can have your money managed for you in an asset allocation based on investment strategies by Nobel laureates and whatever that the whole industry has used since 1950, 1960. The key for investing, as we know, is to continue for the long term. Continuously have discipline to invest every single 2 weeks or every single month a certain amount, and hopefully it grows over time as your income grows, in a proper asset allocation based off your risk tolerance for as long as possible. Because we know that stocks, will return 6 to 8% annually over the long term, and we know that bonds return about half that. And robo-advisors are filling a huge need. It's just the people I talk to, like the millennials I talk to, and people who are in their 40s, a lot of people have way more cash than historically because of all these massive corrections of volatility. So I actually don't think that's that bad of a thing, but I think if you stretch that time period out over a 20, 40-year period, you have to invest because of inflation and because of the opportunity cost of not investing. And so robo-advisors, they lower the hurdle to transact, and I think that's a great thing. You can just link up your checking account. You can sign up for free and play around with their models. I think it's going to be great. The only problem for them is that they don't make enough money to be operating profit positive, right? So, if you manage $1 billion under management, I mean, that sounds like a lot, but that's tiny in the whole $1 trillion wealth management industry.
Right.
But even if you only, charge 1%, it's not a lot of money.
Right.
Because it costs a lot to run these.
And then the robo advisors are only taking and Betterment's taking 0.15%, right?
Yeah, it's the highest is 0.25% between those two. And, it kind of goes lower and lower the more you have. So you really need tons and tons of assets under management, and that's going to get to profitability. So right now it's all being subsidized by funding. And so the big question people have is, will the subsidies be enough for them to get to, run on their own? And if not, like we saw in the fourth quarter of 2015, when private equity funding really dried up, then all many of these companies are just going to go under or get taken under or just stop.
Oof.
So, as a consumer, we want more funding to go to these guys to subsidize us, and then we'll join their platform, and then it'll be good for everybody because the guys who are charging 1% to 3% will come down and come up with their own solutions for the better of everybody.
Yeah, I agree totally. So we had John Stein, the Betterment CEO, on the show the other day, and really like what he had to say. And I've invested both in Wealthfront and in Betterment, and absolutely love both of them. And I think, like you said, the other financial advisors out there, the more traditional ones, I think they're really have to innovate or come up with maybe even a robo advisory solution of their own. That's going to have to be much lower fee, because I think the whole industry is changing very quickly, and people are. I mean, the growth in robo advisors is pretty amazing. I think both Wealthfront and Betterment are over $5 billion in assets under management now. It just makes sense. Like you said, from a consumer level, I think it's great. And hopefully they're able to stay in business and continue to grow, and we can all take advantage of it. So Sam, what else? I know we're coming up on an hour. I want to be conscientious of your time, but I have a couple other questions about, like, do you have an investment that you particularly love, like that you just like, not necessarily for the returns or for the safety, but you're just like, I just like this. I like being a part of it. It's interesting.
Real estate used to be my favorite asset class to build wealth because there is tangibility and utility in real estate. And the worst case is if it all goes to hell and you're living in your house, well, at least you have your memories. And right. So real estate was number one, right? Yeah. Because like with stocks, it goes up and then it goes down, and then you're like, well, crap, nothing really happened, right, if you don't sell. So I think the best home run is where you can invest in something and enjoy something at the same time. So that used to be number one. But recently, and I wrote in an article, real estate versus online income. I actually believe that the best investment is building your own platform online. You have companies like LinkedIn, Google, Facebook. They've all become multi-billion-dollar companies thanks to the internet. But the great irony is that most people don't brand themselves online, right? They don't get their name.com and brand themselves. They actually help LinkedIn, Facebook, Twitter, whatever, get bigger and wealthier and get more traffic by establishing their brand on their platform, right? And I'm telling my readers and anybody who wants to listen, they're already rich. They're already huge. If they can do it, why don't you do it for yourself? So I firmly believe everybody should register their domain online or come up with some kind of catchy name that stands out and brand themselves, like today. We all do this already in the digital nomad sphere, but I think more people need to do it. Own your brand, because a lot of good things will come. If you think about your next investment, let's say you invest $1,000 or $10,000 in your real estate or a stock or a bond. Yeah, you might get, if you're lucky, 2 to 15% return per year. But if you invest that $1,000 in starting a site, or $500 in getting a designer to have a nicer banner, or working on something to build a product, man, you could build a huge return. Like 2 to 15% is like nothing. It's just not, you don't even want to bother. Yeah. The stuff that you do online can generate 100% annual returns, for example. So I think more people need to think about that. So I wrote the book, How to Engineer Your Layoff, Make a Small Fortune by Saying Goodbye, about severance and negotiations. It's not a huge selling book, but it sells about $3,000 of copies a month. And that took about 6 months of work, 3 editors, 12 revisions, whatever. But after 6 months of work, just like focused work, it's an annuity that pays $36,000 a year.
That's great.
So how much capital do you need to generate $36,000 a year? So you need like $1 million in capital at a 3.6% rate of return to generate $36,000 a year.
Yeah, exactly.
So what's easier? I mean, spending 6 months working with a partner to invest in and create a product that will generate something, or try to save $1 million right now. I mean, I would say it's more fun and it's easier and it's more rewarding to try to build a product and brand yourself than to try to save $1 million yourself.
I like it. So I guess your favorite investment then would be anything that you've built yourself, right? Financial Samurai or the books that you've written? Anything
you build yourself online, because we all know that there's over 3 billion people online. The scalability of the internet is more than your cupcake store on the side of the street that you got to pay $4,000 a month in rent to, right? The internet is just such a no-brainer, and I'm disappointed that I didn't start in 2006 when my dad told me because I was too busy. But better late than never, right? Thank goodness, there's a huge financial crisis that made me question what I've been doing. And that's really it. It's like, it always is like something has to really change in your life for you to take some action. And the statistics show, like if you look at click-through rates or conversion rates and all that 90 to 95% of people who read something that is logical, that encourages them to take action, that would be good for them, 90 to 95% of the people don't do anything.
Yeah.
And that's a shame.
Yeah. Well, you'll be forgiven for not taking your father's technical advice in 2006, but definitely good that you got started and gotten to where you're at. And like, how do you track all of your investments or even like your net wealth with having so many investments and all these different income streams coming in?
Yeah, I mean, I used to just geek out on a spreadsheet and have a line item for every single investment. So now I just use Personal Capital to upload all my accounts and that are automated and update them manually as well for those that can't be linked automated onto an app. And then I just check, once a month and see how things are going. And you can scroll by assets, liabilities, specific asset classes, and so forth. It's really complicated where I have over 35, I think, financial accounts, which is complicated. And actually it makes me think, maybe I should just simplify a little bit more.
That's no fun. That's no fun to simplify.
But it's simplified in terms of being automated using technology.
Yeah, so I'm still using the Excel spreadsheet, which I update each month, and I've been looking for a better way to do that. So I'm definitely going to check that out. What was it called? Personal Capital? Personal
Capital, the app. It's free. Check it out. It's a pretty slick and sweet device to manage your net worth and track your net worth, and also to see how your retirement future could be. So I think it's great.
Nice.
It's kind of like Mint, but more investment focused.
Good stuff. We'll definitely take a look. So that kind of brings us to the summary. Like how's retired life or the semi-retired life, and how it's taking you some time to get here, and now you're at a totally different place than you were when you had the full-time job. Like how do you spend your time, and how do you view kind of where you're at now?
I recently wrote a post called Life After Financial Independence. And it's interesting because it's been about 5 years since I left corporate America. And I realized several things. One, like before you reach retirement or before you have your financial independence or whatever, there's this idealized notion of FU money, where all you want is FU money so you can tell everybody who wronged you to F off. And what I realized is that you actually don't care anymore once you have FU money or enough money to declare yourself financially independent. In fact, you start becoming more empathetic to other people's struggles, and you want to just kind of actually listen and help people more. So I think you actually become a better person after you reach your goals, because we all have insecurities, we're competitive, we see other people doing well and all that. And so early retirement is just a stage. It's just a chapter. It's like one stop. You think the last chapter of your mystery novel is going to be amazing, but you realize after you finish reading it, there's actually volume 2 in the series. And then you look back and you say, the whole struggle, the whole journey was actually the most fun. Because the worst case scenario for most of us living in a nice place is actually not that bad, right? We still have food, we still have water, we have internet, public libraries, whatever. So what I've realized as I approach 40 next year is you become a better person, you become more empathetic, you realize financial independence is just one stage, and you actually really just want to help other people achieve the same thing, because you realize how awesome it is. I don't want to be the annoying guy who writes on my site, look at my awesome life. I actually just want to write about ways where you can achieve the lifestyle that you want. And I don't know the best way to do it except for to write about things that'll help people save more, make more, and be happier. It's absolutely worth the sacrifices you make now. The 5 a.m. wake-up call to work for 2 to 3 hours before you go to your day job. All that stuff is absolutely worth it. I had a friend who I'd known for 10 years in my day job. He was 56 years old, and he was the mailman. And 2 days before he got let go, he told me, "You will regret more the things you don't do than the things you try." And then he was gone. And I said, wow, thanks for the loyalty. That's like bullshit. Like he's been here for 10 years and he got laid off. That's crap.
Yeah.
So I just want to try and do the things I want and kind of look back and not have any regret and be able to write things that will perpetually help people get to where they want to go. And I think it's going to be perpetual because whatever you write on the internet is going to live on forever, right? So
yeah,
that's basically my goal.
And I mean, your blog talks about so much of this stuff in detail and a lot about smart, practical steps and being responsible, which I really like. And I think it can apply to anybody. And there's still a lot of people that, even though you can read it and say, this all makes sense, there's people that just won't apply it. And I think it's really important. And you mentioned it earlier about, 99% of people will read something that they agree with and it makes sense, but they just won't take action on it. And this stuff all just comes down to taking action and prioritizing it in your life. And I wanted to know, again, all this stuff is on your blog, but we have a lot of young listeners, early 20s, just starting out, have aspirations to kind of follow a path like you've created in your life. And just, do you have any simple advice for people that are just starting out to kind of take the first steps in their financial independence?
Yeah, so I like to tell everybody the amount of money you're saving each month doesn't hurt. You're not saving enough. You have to make it hurt. You have to, because once you know it's hurting, it's like kind of braces. If you've ever had braces, when your teeth are like in so much pain, it's working. Your teeth are going to be straight. So if you know that the amount of saving each month is a little painful, you've got to be cognizant of it. Then I think that is only when you're really saving enough. Because what you want to do, if you're in your early 20s, you might be really optimistic and bright-eyed. You just graduate from college or whatever, or high school, and you're like, I'm going to work, and I love my job, and I love the mission, and I love the people. But what happens is that over time, maybe over 10 years, you will change to the point where you'll be like, you know what, this is kind of boring now. And there's so many bad things that happen. Nobody's going to live the charmed, perfect life, right? So there's always going to be something bad that's going to happen, unfortunately. And by the 10-year mark or the 15 or 20-year mark, a lot of people just say, I would like to do something else with my life, but crap, I can't because I don't have enough savings or I don't have enough passive income or I didn't brand myself online. What you want to do if you're a younger person is to be able to build that savings hoard, build your brand, build those passive incomes, so you can have that option, to have the optionality to do whatever you want. That is like the key there. That really is the key, to know and believe your elders that things get boring after a while and bad things happen, and to be able to put the sacrifices now so that in 10 years, when you're 30 or 35 or 40, you can make a change. It's the people who cannot make a change, who are very bitter, who are very unhappy, who hate life, and that's no fun.
Great practical advice. Really appreciate you sharing that. So guys, definitely, if you have not read the Financial Samurai blog, read Sam's book, also very highly recommended. We'll leave links to all this in the show notes. I just want to read out a few of my favorite of your blogs. The titles: How to Make Six Figures Income at Any Age, How to Retire Early and Never Work Again, Achieving Financial Freedom One Income Stream at a Time. I had my girlfriend read a ton of these to me while we're driving through the Austrian Alps over the last couple of weeks. Love them all. So thanks again for coming on the show, Sam. We really appreciate this. And I know our listeners will enjoy the episode. We will leave links and everything in the show notes, and we'll continue following you. Thanks for all the great content, and again for coming on the show.
Thanks for having me, guys. Thanks, Sam.
Man, that was a great episode. I learned a ton from Sam. It was kind of very cool to kind of hear his story and how he went through from making, he didn't say exactly, but he kind of implied it was way over $200,000 a year to quitting that or purposely getting laid off from that to start his own journey, pretty much as just the Financial Samurai blogger.
Yeah, I love it. He's pretty open on his blog. If you guys want to take a look and see a little bit more about where he invests and the type of wealth he's been able to accumulate and put to work for him, I would highly recommend it. I actually have 4 or 5 of his blogs open on my screen for my flight home to the US today. I'm gonna catch up on. But yeah, that was an awesome episode, man. I really like these stories, not just about full-on investment strategy, which of course we did talk about that in that episode, but how he got to the point from being able to, be in corporate America into being able to turn into a full-time investor. And then what are his favorite type of investments, right?
Yeah. And I think a couple of the golden nuggets I got of it. One was the fact that you'll never become truly rich just through passive income. And even though I love passive income, I know this is true because the best you can do is kind of just add like a little bit more every single couple of months, every single year. And it's really hard to go from zero to becoming a multi-millionaire if you are just adding a couple $100, a couple $1,000 in passive income every month.
Right.
It's a great way to live an amazing nomadic lifestyle, or even to be able to kind of retire young. But if you want to make that big money, you have to take those big gambles.
Yeah, I agree. And I think it is a good way. Like if you're getting started young, say you're in your 20s, even in your teens, right? You start investing through one of these robo advisories and you're optimizing kind of around 8%. It is a good way to set up for retirement, but it's not a good way to retire by the time you're 30, right? And so that was a lot of what Sam's story was, he learned a lot about investing when he was in corporate America, but he was able to parlay an early win in a risky stock investment, which he made, somewhere over $100,000. He was able to parlay that into acquiring a rental home, a rental house, or a property, and then it's been able to continue to save and build off that, and and then he was able to achieve a lot of financial freedom by the time he was 34.
Yeah, I personally wouldn't recommend anyone spend $3,000 on penny stocks that may go to zero or may just end up losing money with a very, very tiny chance of it, growing to be worth as much as it was for him. But at the same time, I do agree that if you take a small portion of your earnings or your net wealth and then take a bit of a gamble with it, it's not the worst in the world. And if it does hit big, that's kind of when you cash in. And what I liked even more is the fact that his second step was to take that money that he didn't really earn and put it towards an actual asset that you're probably not going to lose, like his rental income, versus having the mentality like, oh, well, I just made this money out of thin air. Let me just try to grow it again.
Right. Yeah. And another thing that we touched on in this episode, which he also goes into a lot of detail in his blog that I love, is frugality. And he talked a lot about how he lived very frugally. And of course, in your episode last week, Johnny, you talked about living off $600 a month. And for anyone who's listening to this show, who's trying to grow wealth and trying to become more successful in their own right, frugality is so important, right? It's if you go out and buy that $80,000 sports car and you're going to blow, $2,500 a month on a nice apartment for rent, it's going to be harder and harder to save that much money. So if you really take a look at your expenses and you look at, say, a 5-year time frame, and you can trim your expenses down, stop eating dinner out and buying $100 bottles of wine every night, don't rent that sports car, don't buy that sports car, learn to live a little bit more frugal, you're going to be able to save a lot more and put a lot more of your money to work for you.
Yeah, and I definitely agree. I think part of it maybe, and I don't think he even alluded to it, but I was just reading a Forbes article that he wrote, and he mentioned that he's Chinese American who grew up in Malaysia, Taiwan, and Japan, the Philippines, and China. So I guess just like me, I kind of grew up with that it's like innate in the Asian American culture to be able to save and be a bit frugal, and I think that's helped both of us a ton. Versus maybe someone who kind of grew up thinking, oh, it's fine to buy $100 bottle of wine every weekend.
Yeah, but also when we grew up, savings rates and banks were like 5-6%. I can remember when I was just like 12 years old, and I would save money that I got from my parents or whatever for a birthday, $100 here, and doing little summer jobs, mowing the lawn and stuff here and there. And when every quarter you would get a statement from the bank, they would actually say you made $30 or something. And as like a 12-year-old, that was amazing. So savings rates back in the day made it a little bit more appealing for youngsters to save, for anyone to save, but it helped instill those types of values, right? Whereas now, like someone who's 15 and putting money in a savings account, they're not getting anything. In some countries, they might be actually losing money. So you have to be a lot more disciplined now and learn better ways to start off and to be frugal, of course, as well.
Yeah, and I think that's really good advice for people who want to to grow their bottom line, to grow their net worth. I think it's really cool that he drives a Honda Fit, even though he can afford a much nicer car. He talks about it. Right. One of his articles called Stealth Wealth, which I think is really cool. I think it makes a lot of sense where if you want real genuine friends and you don't want people to expect you to pay all the time, it is a good idea to kind of keep how much money you have kind of under the radar. I think me and you are a little bit, a bit open, so I think people know how much money we're making. But it's at the same time, it's like, I think if you're living in a city, like we're traveling so much, I don't think it really matters because we're kind of running with a different crowd. But if you're like living in a city and you have, a house and you are meeting just very normal people that have a very normal job, you probably want to keep it under wraps. And I think by driving a Honda Fit is a great idea.
Yeah. Well, as they say, $1 saved is $1 earned.
Yeah, actually, $1 saved is $1.10 earned if you invest it correctly.
If you put it in Wealthfront and the market goes up.
That is true. So it's actually a really great idea. So if you guys want to check out Sam's book, it is How to Engineer
Your Layoff, and we'll leave links to that in some of the blogs that we referenced, including the Stealth Wealth one, in the show notes. So feel free to check that out. And some reviews kick off. Yeah,
very, very excited for our latest review from Australia by Fire Bright. They said, just awesome. 5 stars. I really love this podcast. It's just awesome. I've been following Johnny FD for a long time, and I've read his books and also listened to the Travel Like a Boss podcast. It's just so inspiring to hear all these investment tips and rags to riches stories. Love it. Keep up the good work, guys.
Okay, I have one from my boy Fergus Tonkin, and he said, learned more than I expected, 5 stars. Great work from these two. I love how anyone can listen to these podcasts and pick up new things. I've listened to every episode up to episode 10 so far and plan to continue. So guys, thanks so much for the reviews. Honestly, this is the best way for us to get better and better guests. When we invite guests on the show, the first thing they look at is how many reviews we have and what the reviews are, and then they'll take a listen. So if you want us to continue getting better guests and bring you more and more information, please just take the 2 or 3 minutes to leave us a couple or one review would be great.
And as a big thank you, we are continuing to give away $25 Amazon gift cards every single month for anyone who releases reviews and sends in a screenshot, just so we have your email address, so we know where to send the gift card. And this month we are going to send it to Ferguson. Is that his name?
Okay, Fergus Tonkin. Okay, yeah.
Fergus Tonkin. And
Tonkin.
You know what? And he sent in the most ghetto screenshot ever I've ever seen in my life. Both Sam and I had to zoom in 10x to try to figure out what this said. So we're gonna link this in the show notes, so you can see you could take the most ghetto screenshot in the world and you could still win $25 as long as you leave us a review. So if he can do it, so can you.
Yeah, Fergus, you got to let us know what you're buying with a gift card, though. You got to make it something cool.
Yeah, I hope it's a down payment to screenshot software.
Screenshot software, yeah. No, it's okay. Buy something fun with it. Let us know what you bought. You can even buy Johnny and I a gift and send it back to us if you want.
Thanks so much. All right, guys, and I'll see you all next week.
Thanks for listening to the Invest Like a Boss podcast. Join our mailing list at investlikeaboss.com to get exclusive access to our insider investment portfolios and our private members forum.
If you enjoyed this episode, please subscribe on iTunes or your favorite podcast app. Tell your friends and leave us a review in the iTunes store. It helps more than you know. See you guys next week.